What's truly critical for, investors and analysts to grasp here is that constant currency nuance. In a world with volatile global economies where exchange rates can make numbers look better or worse, seeing a 13% growth rate, even after removing those currency fluctuations, signals genuine, organic, underlying business momentum. It really does. It tells us that the demand for Alphabet's incredibly diverse portfolio of products and services, from search ads to cloud subscriptions, is intrinsically strong and expanding. It's not merely getting a boost from a favorable dollar or euro, This kind of consistent double-digit constant currency growth is a very healthy sign for anyone looking at the sustainability and organic expansion of a company the size of Alphabet. It means their core business is truly growing, not just benefiting from those external factors.
Right. And how did that impressive top-line revenue growth translate to the bottom line? How profitable was this quarter for Alphabet, and what does it tell us about their operational efficiency?
Well, the total operating income, which is, essentially the profit generated from their core business operations before taxes and non-operating items, it increased by an equally impressive 14% to $31.271 billion. And perhaps even more importantly, the operating margin held remarkably steady at 32.4%. That consistency in margin, while simultaneously growing revenue at double digits, well, it speaks volumes. It shows their ability to translate sales into profit is incredibly efficient. This margin stability, as the report points out, benefited from the strong revenue growth we just discussed, and crucially, from continued efficiencies in the expense base. This suggests that even as they pour massive investments into AI, they're simultaneously managing their operational costs effectively, possibly through, automation or just economies of scale within their vast infrastructure. However, it's worth a specific note here that this positive trend was partially offset by a one-time charge. It was related to a legal settlement in principle. Now, while that's not a recurring operational issue, these kinds of charges can create a temporary drag on the immediate financial picture. But for the long-term investor, maintaining such a strong operating margin while growing revenue so rapidly, even with an external hit like a legal settlement, it truly underscores the inherent efficiency and scale of Alphabet's core businesses. It really does. It demonstrates that their underlying operations are not just growing, but they are also exceptionally profitable and incredibly well managed. This kind of consistent margin performance provides a solid, predictable foundation for future earnings, which is, a key indicator of a healthy enterprise.
Absolutely. And then we get to the numbers that often get the most attention from shareholders: net income and earnings per share, or EPS. These are the crucial figures that directly reflect how much value the company is creating for its owners. What do they tell us?
Well, the numbers are undeniably strong here. Net income jumped a very robust 19% to $28.196 billion. And diluted earnings per share, or EPS, which is essentially the portion of a company's profit allocated to each outstanding share of common stock. A critical measure for shareholders to understand their slice of the pie, right? That soared an even more impressive 22% to $2.31. Now, this accelerated growth in net income and EPS, outpacing even their strong revenue growth, that's a very positive signal. It indicates what we call improved operational leverage, which is a fancy but important way of saying that for every new dollar of revenue Alphabet brings in, a larger percentage of it is now trickling down to profit. Think of it like a baker who buys more ingredients in bulk and, without significantly increasing his fixed cost for the kitchen, can produce many more cookies, making each additional cookie more profitable. It's a very healthy sign for sustained profitability and scalability. Now, if we connect this to the broader financial picture, a significant factor contributing to this net income boost was something for other income expense net. Okay, this line item shot up dramatically to $2.6662 billion from just $126 million in the prior year, a huge jump. This substantial increase was primarily driven by a $1.286 billion gain on equity securities. Think of these as, investments in other company stocks, and $419 million from what are called equity method investments, typically stakes in privately held companies where Alphabet has significant influence. Now, while this is clearly a positive for the bottom line in this particular quarter, the report also includes a warning that fluctuations in these investment values can contribute to volatility in this line item in the future. So this raises a crucial question for investors, doesn't it? How much of this impressive bottom line jump, especially the accelerated EPS growth, is truly from their core operations like advertising and cloud services versus gains from their financial investment portfolio? While any gain is good, of course, understanding this distinction is key to assessing the sustainability and predictability of future core earnings. It means that while the overall profitability picture is excellent, it's always wise for an investor to, dissect the composition of those gains to truly understand the underlying business performance.
That's a vital distinction.
Yeah.
It's not just what the profit is, but how it's made. Absolutely. Let's move from the consolidated view and break down where these impressive revenues are actually coming from. Starting with the colossal Google Services segment. This is arguably the bedrock, the vast engine of Alphabet's financial success, encompassing everything from the omnipresent search and YouTube to Android, their Pixel devices, and their growing array of subscriptions. This segment alone brought in a massive $82.5 billion. That represents a robust 12% increase year over year.
You're absolutely right. This segment is truly the behemoth. And it's vital to remember that Google Services is no longer just synonymous with advertising. While ads remain dominant, of course, it's evolved into a remarkably diverse ecosystem. The growth we're seeing in areas like subscriptions and devices shows a very deliberate and frankly successful strategy to diversify their revenue streams. This diversification makes the overall business more resilient to fluctuations in any single market, which is, a powerful advantage in today's rapidly changing tech landscape.
Let's hone in on search, which for many of us is still the beating heart of Google. How is that core search business performing, especially with all the talk about AI integration? Is AI enhancing search, or is there maybe a risk of it cannibalizing their core ad revenue? That's a big question.
That's the million-dollar question, indeed. And the answer from this report is, well, incredibly insightful. Google Search and other revenues reached $54.19 billion, demonstrating incredibly strong double-digit growth. Sundar Pichai specifically highlighted that Search delivered robust double-digit revenue growth. So the core is strong. But here's where it truly gets fascinating for the future of search, particularly with the deep integration of AI. Pichai noted that their new search features, powered by AI, are performing exceptionally well, and they are already having a significant positive impact on user behavior, which might actually surprise some people. Take AI overviews, for instance. These are those, synthesized AI-generated answers that appear directly within your search results. The report states they are now driving over 10% more queries globally for the types of searches where they appear. Now, this is a critical metric for Google because it demonstrates that rather than providing a complete answer that might reduce user clicks to external websites, which is where Google earns its ad revenue, these AI summaries are actually encouraging more user engagement and follow-up questions. It's quite interesting. They are used by over 2 billion monthly users across more than 200 countries and territories and 40 languages. That shows truly global adoption. And the key takeaway here is that these AI overviews are now powered by Gemini 2.5, which Google claims delivers the fastest AI responses in the industry. Speed is absolutely paramount for user experience and real-time interactions, right? I mean, a slow AI response is often a useless one in search.
Yeah, absolutely. Speed matters.
Beyond AI overviews, their new end-to-end AI search experience, imaginatively called AI Mode, is also getting significant traction. It already boasts over 100 million monthly active users in the US and India, and it's receiving very positive feedback, especially for longer, more complex, or nuanced questions that, traditional keyword search might struggle to interpret. This signals a fundamental shift in how people expect to interact with search, moving from fragmented keywords to more conversational, comprehensive queries. This raises an important question for the future of how we interact with information, doesn't it? What does this mean for our long-standing search habits? Well, Pichai explicitly stated that their AI features are actually causing users to search more, because they're learning that search can now meet a much broader range of their needs, acting almost like a personalized research assistant. This growth is especially pronounced among younger users who are already more accustomed to conversational AI interfaces and quickly adapt to new ways of information discovery. This implies a profound generational shift in search habits. Moving from simple transactional queries to more exploratory, complex conversations that AI is uniquely positioned to handle. Looking ahead, they plan to keep enhancing AI Mode with features like Deep Search, which hints at even more sophisticated information retrieval by understanding complex concepts rather than just matching keywords, and more personalized responses, making search even more tailored to individual user intent and history. This continuous innovation is designed to keep Google firmly at the forefront of how people discover, understand, and interact with information. For an investor, this suggests an expansion of the addressable market for search rather than a contraction, which is key.
That's a fascinating reframe. AI leading to more search, not less. Interesting. But let's turn our attention to another content powerhouse, YouTube. It's clearly diversifying its revenue streams beyond just advertising. How is it performing, especially with the rise of, short-form video platforms?
Well, YouTube ads generated $9.796 billion, reflecting incredibly strong performance and sustained momentum. This continued growth demonstrates the platform's ability to attract and retain advertisers despite an increasingly fragmented and, frankly, competitive digital media landscape. But what's truly fascinating here, and a critical insight for anyone looking at YouTube's future, is the remarkable success of YouTube Shorts, their direct competitor to platforms like TikTok for short-form video. The report highlights that in the US, Shorts now earn as much revenue per watch hour as traditional in-stream ads on YouTube. That is an absolutely monumental achievement, considering Shorts averages over 200 billion daily views.
Wow, parity already. That's huge.
It is huge, because monetizing short-form video has historically been a significant challenge for platforms, given the rapid consumption and fragmented attention spans, right? For YouTube to achieve parity in ad revenue per watch hour with its traditional longer-form content demonstrates they've cracked the code. They figured out how to integrate ads seamlessly into a fast-paced viewing experience. This is a significant competitive advantage in the short-form video space. And AI's role in YouTube is also expanding beyond just content recommendations. AI is actively helping improve overall recommendations, which directly translates to increased watch time and deeper user engagement, keeping eyes on the platform longer. It's also powering auto-dubbing, which significantly enhances the global reach for creators and brands by dramatically increasing the potential audiences they can reach across language barriers. Imagine being able to effortlessly connect with viewers in dozens of languages. That's a game changer for content creators. They've also started rolling out a whole suite of new AI tools for creators on YouTube Shorts, empowering content creators with advanced capabilities that will likely drive even more unique and high-quality content creation on the platform, further solidifying its position.
So AI is boosting creator reach and tools too.
Exactly. And beyond advertising, YouTube continues to strategically diversify its subscription options, which provides a more stable, predictable, and recurring revenue stream, less susceptible to the ebb and flow of advertising markets. They recently expanded their Premium Lite offerings that gives ad-free viewing without all the other premium features to 15 new countries, with more to come. Further growing their subscriptions business, this is a deliberate move to cater to different user needs and price points. If we connect this to the bigger picture, Nielsen data shows YouTube has led U.S. streaming watch time for over 2 years, consistently outpacing traditional TV and other streaming services. This indicates a generational shift in viewing habits, particularly towards watching creators and user-generated content on televisions, which opens up new premium advertising opportunities on larger screens and allows for deeper, longer engagement sessions. They also consume over 40 billion hours of sports content annually, including the upcoming NFL's First Friday game streaming live from Brazil, cementing their position as a major player in live sports and premium content, which draws massive, highly engaged audiences.
Okay, so search and YouTube are clearly powerhouses, benefiting significantly from AI and diversification. But while the growth in those areas is phenomenal, were there any segments within Google services that didn't quite see that stellar growth? Perhaps a small crack in the otherwise shining armor.
Indeed, it's important to look at the full picture. And yes, while overall growth was strong, Google Network revenues saw a slight dip, moving from $7.444 billion in Q2 2024 to $7.354 billion in Q2 2025. Now, while not a dramatic drop in absolute terms, it's worth observing against the backdrop of overall robust growth across all other segments. This segment typically refers to Google's AdSense network on third-party websites, where Google helps other publishers monetize their traffic through Google Ads. This slight decline could suggest several things. Maybe shifts in programmatic advertising trends, increased competition in the broader ad tech ecosystem from other platforms, or even changes in how publishers are choosing to monetize their sites, perhaps opting for direct sales or different ad formats. It's a relatively small piece of the overall revenue pie for Google, but it stands out as the only segment within Google services that didn't show growth this quarter. And as such, it's an area worth monitoring to see if it's just a minor blip or perhaps signals a deeper trend.
Got it. Something to keep an eye on. But on the flip side, subscriptions, platforms, and devices are booming, right? This seems to be a significant and growing area of diversification for Alphabet.
Absolutely. Google subscriptions, platforms, and devices surged to $11.203 billion this quarter. That's a substantial increase from $9.312 billion in the prior year. This segment is increasingly pivotal as it bundles together a wide array of consumer subscription-based products like YouTube TV, YouTube Music, and Premium, Google One, which offers cloud storage and other benefits, and, of course, sales of their own brand hardware like Pixel phones, Nest products, and Fitbit devices. The CEO's remarks also directly linked this impressive growth to the boost from new premium AI offerings. specifically mentioning Google AI Pro and new Google AI Ultra plans. This is a clear strategic indicator of how AI is directly contributing to entirely new revenue streams for Google. They're effectively monetizing advanced AI features through premium subscription tiers, a deliberate and frankly smart move to convert cutting-edge technology into tangible, recurring financial returns. This successful diversification significantly lessens Alphabet's historical reliance on traditional advertising, providing a more stable and predictable revenue base for the future, which is always attractive to investors,
Right. Recurring revenue is key. Okay, now let's shift our focus to Google Cloud. This is a segment that truly encapsulates Alphabet's aggressive and highly strategic stance in the current AI arms race. This has been an area of colossal investment and, increasingly, of very significant and accelerating returns.
Yes, Google Cloud revenues soared to an impressive $13.624 billion. That marks an astonishing 32% year-over-year growth. But what's even more compelling for investors, I think, is its rapid and decisive ascent into sustained profitability. Google Cloud's operating income jumped dramatically from $1.172 billion in Q2 2024 to $2.826 billion this quarter.
Wow, more than doubled.
Exactly. This dramatic increase in profitability, achieved alongside substantial double-digit revenue growth, is a critical turning point for Google Cloud. It signals that it's not just a growth engine, but a powerful, highly profitable one, directly challenging its competitors like AWS and Azure. Sundar Pichai emphasized that its annual revenue run rate is now more than $50 billion. Now, a run rate is simply an annualized projection based on the most recent quarter's performance. You basically multiply the quarter's revenue by 4. So $13.624 billion for the quarter means a $54.496 billion run rate. This figure indicates immense scale and consistent momentum that firmly positions Google Cloud as a major, formidable player in the enterprise cloud market.
That kind of acceleration and profitability turnaround in cloud is phenomenal, especially when we talk about AI within that segment. What exactly is driving this, and how are they making such significant inroads with major enterprise customers?
Well, Pichai explicitly attributed this acceleration to, quote, strong customer demand, driven by our product differentiation and our comprehensive AI product portfolio. And the data provided in the report powerfully backs this up with some truly compelling statistics. Statistics that demonstrate their traction with the largest, most demanding enterprises. For instance, they've seen a doubling year over year in the number of deals valued over $250 million. That indicates they were securing more substantial, high-value contracts. Even more impressively, in just the first half of 2025 alone, they signed the same number of deals over $1 billion that they managed to secure in all of 2024.
The same number in half the time.
Exactly. This isn't just growth. This highlights a shift towards larger, more strategic, multi-year wins with major global enterprises. Companies who are committing significant portions of their IT budgets and digital transformation initiatives to Google Cloud services. Furthermore, the number of new Google Cloud Platform (GCP) customers increased by nearly 28% quarter over quarter, demonstrating a broadening customer base beyond just these colossal deals, reaching mid-market and smaller enterprises too. And critically, from an AI adoption perspective, more than 85,000 enterprises, including major global names like luxury giant LVMH, software powerhouse Salesforce, and Singapore's DBS Bank, are now actively building with Gemini, Google's leading AI model. This is driving a phenomenal 35x growth in Gemini usage year over year within Google Cloud.
35 times.
35x. This is a clear and undeniable signal that enterprises are not just dabbling. They're rapidly and deeply adopting Google's AI models for their critical business operations, solidifying Google Cloud's position right at the forefront of enterprise AI. It demonstrates a profound shift in how businesses are leveraging AI for competitive advantage, and Google is clearly capturing a significant portion of that demand.
Okay, so it's clear they're winning huge customers with their AI capabilities. But Sundar Pichai repeatedly stresses their full-stack approach to AI. What does that truly mean for our listeners, and how does it differentiate them in this incredibly crowded and competitive AI landscape? It sounds like their core competitive strategy.
You've hit on the absolute core of Google's AI strategy there.
Yes.
This full-stack approach is their comprehensive answer to the intense AI race, and it's a crucial differentiator. It genuinely sets them apart from many competitors who might focus on just one layer of the AI stack, Their strategy spans 3 key interconnected pillars, creating a powerful end-to-end offering. First, there's AI infrastructure. Google operates a leading global network of AI-optimized data centers and cloud regions, providing the foundational hardware and network backbone that powers all of this. They also offer the industry's widest range of TPUs or tensor processing units. These are Google's custom-designed chips specifically optimized for lightning-fast AI workloads, alongside powerful GPUs or graphics processing units, which are also vital for AI. All of this comes with integrated storage and software precisely optimized for AI. Now, what's absolutely fascinating here is why this matters so much. This proprietary and extensive infrastructure provides industry-leading performance and unmatched cost efficiency for both training and inference of AI models. This efficiency is critical for complex, large-scale AI operations, where every millisecond and every watt of power matters. It's why nearly all generative AI unicorns, those billion-dollar AI startups, are choosing Google Cloud for their foundational computing needs.
So the best are choosing Google infrastructure.
Seems that way. It's also why a growing number of leading AI research labs like Safe Superintelligence and Physical Intelligence specifically choose Google's TPUs. These are highly sophisticated users, right? So their choice profoundly validates Google's infrastructure capabilities. Furthermore, they've introduced innovative storage solutions like Anywhere Cache, which improves inference latency by up to 70%, and Rapid Storage, delivering a 5x improvement in latency. Both are critical for high-speed AI operations where milliseconds can profoundly impact user experience and application responsiveness. They've also optimized AI software packages like PyTorch and JX with full open source support, making their infrastructure accessible and powerful for a wide range of developers globally. Next, we delve into world-class AI research, models, and tooling. This is about the intellectual powerhouse behind the operation, the continuous innovation in AI algorithms and foundational models. They continue to expand their Gemini 2.5 family of hybrid reasoning models, which they state provide industry-leading performance in nearly every major benchmark. This includes their popular workhorse model, Flash, specifically designed for speed and efficiency in real-time applications, and a new, even faster Flashlight version catering to ultra-low latency applications where instantaneous responses are absolutely key. Demonstrating this sheer research prowess, Google even achieved gold medal level performance in the prestigious International Mathematical Olympiad using an advanced version of Gemini with DeepThink, which they plan to bring to users soon. This is a remarkable feat for an AI model, showcasing advanced problem-solving and logical reasoning capabilities.
An AI winning a math Olympiad. That's impressive.
It really is. They emphasize having some of the best models available today at every price point, which is crucial for broad adoption by developers and enterprises with widely varying needs and budgets. And crucially, a staggering 9 million developers have now built with Gemini, highlighting significant, rapidly accelerating developer adoption, which is absolutely key for ecosystem growth and the widespread integration of Gemini into countless new applications and services. I also want to spotlight VO3, their state-of-the-art video generation model. It's been an absolute viral hit. Over 70 million videos generated since its launch in May, showcasing its incredible creative power. They've also introduced a brilliant feature in the Gemini app to turn your photos into videos, which is now rolling out to Google Photos users, bringing advanced generative AI capabilities directly to millions of consumers. And finally, the third pillar is products and platforms. This is how their cutting-edge AI research and powerful infrastructure actually reach users and partners across their vast interconnected ecosystem. The growth in usage has been nothing short of incredible. At their I/O conference back in May, they announced processing 480 trillion monthly tokens across their various surfaces. Think of a token as a unit of digital information, like a word or part of a word, that AI models process. Since then, in just a few weeks, they've doubled that number. They're now processing over 980 trillion monthly tokens.
Doubled in just weeks. The scale is hard to comprehend.
It's massive. This metric, while technical, vividly illustrates a huge surge in the sheer volume of AI computations and interactions happening across their services, indicating deep, widespread, and accelerating integration of AI into their products. The Gemini app now has more than 450 million monthly active users, with daily requests growing over 50% from Q1. Showing rapid consumer adoption and engagement. In the enterprise space, the impact is equally profound. In June alone, over 50 million people used AI-powered meeting notes in Google Meet, directly improving productivity for millions of professionals. Their new short video product and workspace, Google Vids, powered by VO3, has already reached nearly 1 million monthly active users, demonstrating successful integration of generative AI into everyday business tools. New Android and AI features were also announced for Samsung's latest devices, showing deep integration across their broader device ecosystem. And as we discussed earlier, the new Google AI Pro and Google AI Ultra plans are also boosting subscriptions, demonstrating direct, tangible monetization of these advanced AI features.
That's a staggering amount of AI activity happening across their platforms. It really is everywhere. But you mentioned AI agents being integrated into cloud products. Can you give us some specific, tangible examples? How are these AI agents actually helping businesses in the real world? And what does this all mean for enterprise efficiency and, ultimately, Google Cloud's competitive edge?
Absolutely. This is where the rubber really meets the road, isn't it? These aren't just theoretical AI capabilities. They are profoundly impacting enterprise operations right now. For example, Wayfair, the online home goods retailer, is leveraging AI-integrated databases on Google Cloud to power hyper-personalized customer experiences, making shopping feel more tailored and intuitive for millions. Mattel, the toy giant, is using Gemini-powered data agents and BigQuery, Google's enterprise data warehouse, to quickly review and act on product feedback. This means they can respond faster to market demands, leading to accelerated product development cycles and more relevant products, faster innovation.
So faster product development for Mattel?
Exactly. Target, the retail giant, is using Gemini-powered threat intelligence and security operations agents for enhanced cybersecurity. This is critical for protecting sensitive customer data and critical business assets in a world of ever-increasing cyber threats. Capgemini, a global leader in consulting and technology services, is utilizing AI software engineering agents for faster software development, automating tasks from code generation to testing. This dramatically increases developer efficiency and accelerates project delivery. And a standout example is BBVA, one of the largest banks in the world. They've reported that Gemini and Google Workspace is saving their employees nearly 3 hours per week by automating repetitive tasks. That's a massive productivity gain that they are now rolling out to 100,000 employees globally.
The 3 hours per employee per week across 100,000 employees. That's huge savings.
Yeah. Imagine the sheer volume of hours and cost savings this represents across a massive enterprise. It's immense. So this raises an important question. What does this mean for overall enterprise efficiency? These clear, real-world examples unequivocally show AI agents automating complex, time-consuming tasks across various functions, leading to significant time and cost savings for businesses. This is a powerful, demonstrable value proposition that drives adoption and makes Google Cloud an indispensable partner for enterprises navigating digital transformation and the AI revolution. Furthermore, Google isn't just building for itself, they are intensely focused on building a flourishing open AI agent ecosystem. They released an open source agent development kit, which now has over 1 million downloads in less than 4 months, fostering external innovation and enabling developers outside Google to build on their AI foundations. An agent space, an open and interoperable enterprise chat, search, and agent platform has already secured over 1 million subscriptions, booked even ahead of general availability. This strong focus on an open ecosystem positions them to be a foundational layer for broader AI adoption across countless industries, effectively making them a central, enabling player in the widespread AI revolution. This strategy is critical for fending off competitors by embedding Google's AI models and tools deeply across the industry.
Okay, that makes sense. So it's not just their own products, but building the whole ecosystem. Now, beyond the core businesses of Google services and Google Cloud, Alphabet maintains its Other Bets segment, which is the collection of its ventures into long-term, often high-risk, high-reward projects. What's happening in this segment? Are they still primarily a sink for cash, or are we finally seeing any breakthroughs or signs of impending profitability there?
Well, the Other Bets segment generated $373 million in revenue this quarter, which is a slight increase from the prior year. However, it continues to be a segment of significant investment and consequently ongoing losses. The operating loss for Other Bets increased to $1.246 billion in Q2 2025 from $1.134 billion in the prior year. Now, while this segment remains a financial drag on Alphabet's overall profitability, it's absolutely critical to understand that it's a relatively small piece of the total profit and loss statement, given the company's vast scale and immense profitability from Google services and cloud. This reflects Alphabet's strategic willingness to invest in future disruptive technologies and maintain a portfolio of moonshot projects, as they call them. They They are essentially betting on truly transformative technologies that might take a decade or more to mature, but have the potential to unlock entirely new, massive markets. It's a long-term play, a strategic allocation of capital towards potentially paradigm-shifting innovations. Waymo, their autonomous driving technology company, is a prime example within other bets that continues to scale and expand at an impressive rate. Just last month alone, Waymo launched its fully autonomous ride-hailing service in Atlanta, a major metropolitan area. They also significantly more than doubled their Austin service territory and expanded their existing Los Angeles and San Francisco Bay Area territories by approximately 50%.
So real, tangible expansion happening.
Absolutely. This rapid expansion shows a maturing technology ready for broader public adoption. A particularly interesting development for future growth is the launch of teen accounts in Phoenix, allowing riders aged 14-17 to use the service with parental oversight. This broadens their potential user base and introduces autonomous ride-hailing to a younger generation. The Waymo driver has now autonomously driven over 100 million miles on public roads. To put that into perspective, that's like sending a self-driving car around the Earth more than 4,000 times.
100 million miles.
It really underscores the sheer volume of real-world data and experience they're accumulating, which is the secret sauce for perfecting autonomous systems. And the team is actively testing across more than 10 cities this year, including challenging urban environments like New York and Philadelphia, which possess unique complexities that further push the technology's capabilities. This long-term bet continues to make significant and measurable progress, showcasing that these other bets are not just theoretical, but are actively developing and deploying incredibly advanced technologies that could eventually become massive new revenue streams.
That's incredible progress for Waymo. It really feels like it's getting closer. But this brings us to a truly crucial point for anyone looking at Alphabet's future, especially from an investor's perspective. Their capital expenditures, or CapEx. The CEO mentioned a massive increase in investment. What does this truly mean for the company's immediate financial health and its long-term strategic direction, especially in the context of this AI arms race?
This is perhaps one of the most significant takeaways from the entire report for long-term investors, I think, as it directly signals Alphabet's unwavering commitment to future growth, especially in the all-important AI sector. Sundar Pichai stated unequivocally that with strong and growing demand for their cloud products and services, they are increasing their investment in capital expenditures in 2025 to approximately $85 billion.
$85 billion. That's staggering.
It's a truly colossal sum, an unprecedented level of investment for Alphabet, clearly illustrating the sheer scale of their ambition and their belief in the future of AI and cloud computing. Now, this immediately raises a critical question for investors. How does such a monumental investment impact the company's immediate financial picture, particularly its free cash flow, which is, a key measure of liquidity? We can see this direct impact reflected starkly in their cash flow statement. While net cash provided by operating activities remained robust and healthy at $27.747 billion for the quarter, their purchases of property and equipment, which is essentially their CapEx, soared to $22.446 billion in Q2 2025. That's up significantly from $13.186 billion in Q2 2024. A huge jump. This dramatic increase in CapEx directly impacted their free cash flow, or FCF, which is a crucial liquidity measure that investors watch closely. FCF represents the cash a company generates after accounting for cash outflows required to support its ongoing operations and maintain or expand its capital assets. Think of it as the real money left over that a company can truly use for things like paying down debt, buying back shares, or pursuing new ventures without needing to borrow more. Well, free cash flow for Q2 2025 dropped to $5.301 billion from $17.637 billion in Q3 2024.
Okay, so a big drop in free cash flow. That sounds negative initially.
It can sound negative, yes. But if we connect this to the bigger picture for investors, this sharp decline in FCF isn't necessarily a negative thing. It is a very conscious, aggressive, and highly strategic choice by Alphabet. They are intentionally reinvesting a huge portion of their operating cash flow directly back into the business, primarily to build out the massive, complex AI infrastructure, new data centers, more TPUs and GPUs, advanced networking required to meet the surging demand for their AI and cloud services. This investment signals a profound commitment to maintaining and extending their leadership position and capturing future market share in the burgeoning AI economy. Even if it comes at the expense of short-term free cash flow, it's a strategic trade-off. They are prioritizing future dominance and sustained competitive advantage over immediate cash generation. This colossal investment is also clearly reflected on their balance sheet, where property and equipment net increased substantially, from $171.036 billion at the end of 2024 to $203.231 billion by June 30, 2025, visually demonstrating the physical expansion of their asset base.
So they're building out aggressively. How are they funding this massive outlay without crippling their balance sheet then?
Good question. Their long-term debt increased to $23.607 billion from $10.883 billion at the end of 2024. This is directly attributable to the issuance of $12.5 billion in fixed-rate senior unsecured notes back in May 2025 for general corporate purposes. This demonstrates they are strategically leveraging debt, likely at favorable interest rates given their strong credit rating, to fund this significant expansion. Crucially, though, they still maintain an incredibly robust cash equivalents, and marketable securities position of $95.148 billion.
Still nearly $100 billion in cash.
Exactly. This substantial cash pile indicates a very strong financial position to comfortably support their ambitious investment plans without putting undue strain on their liquidity. It's a calculated decision to accelerate growth and infrastructure build-out now to capture the immense opportunities presented by AI before their competitors might. For an investor, it shows a company with deep pockets making a very strategic long-term bet.
This has been an incredibly detailed breakdown, thank you. So to bring it all together for our listener, particularly for someone looking at Alphabet through an investor's lens, what does all of this truly mean? Let's conduct a classic SWOT analysis, considering their strengths, weaknesses, opportunities, and potential threats based on this deep dive into their Q2 results. Is Google the right company, and maybe is now the right time to invest?
That's the ultimate question we're trying to get at, isn't it? If we zoom out for a moment, Alphabet presents a compelling case for investors, absolutely, but one that certainly comes with its own set of considerations, as any major investment would. Let's break it down. First, the strengths. Alphabet boasts an incredibly robust core business, no question. Search and YouTube continue to be phenomenal cash generators, demonstrating remarkable resilience and consistent double-digit growth. Their sheer scale and market dominance in these areas provide an immensely stable, highly profitable foundation that fuels all their other ventures, including those massive AI investments. Secondly, they exhibit powerful AI leadership. Google's full-stack approach to AI, spanning from foundational research and cutting-edge models like Gemini 2.5 and VO3 to critical proprietary infrastructure like TPUs and a global network of AI-optimized data centers, and finally to deep product integration across search, AI overviews, AI mode, workspace, and Android. That is a significant, defensible competitive advantage. The rapid adoption by developers, 9 million now building with Gemini and enterprises, with that phenomenal 35x Gemini usage growth in cloud. That indicates strong market traction and validation of their AI capabilities. This isn't just a buzzword, it's a deeply embedded strategy. Thirdly, Google Cloud's impressive turnaround is a major strength now. Its rapid growth at coming to 2% and sharply increasing profitability, now reaching $2.8 billion in operating income, marks it as a powerful, accelerating growth engine, particularly driven by the surging demand for AI from enterprises. The substantial increase in large deals, especially those $1 billion deals, points to deep and successful enterprise penetration, indicating long-term, sticky customer relationships. Lastly, their strategic diversification beyond core advertising is a significant strength. The strong growth in subscriptions, through offerings like YouTube Premium Lite and the new Google AI Pro Ultra plans, adds a valuable, predictable, and recurring revenue stream, reducing reliance on the often volatile ad market. And promising other bets, like Waymo, despite their current losses, demonstrate long-term innovation potential that could unlock entirely new, massive markets in the future, providing significant upside potential for patient investors.
Okay, so very strong core, clear AI leadership, cloud profitability, and diversification. Those are compelling strengths. What about the weaknesses or risks investors should be aware of?
Right, let's turn to the weaknesses or risks. Investors should be acutely aware of these. The most prominent one, I think, is the massive capital investment impact on free cash flow. While strategic and absolutely necessary for future growth, the commitment of approximately $85 billion in CapEx for 2025 will continue to significantly suppress free cash flow in the short to medium term. For some investors, especially those focused on immediate liquidity or shareholder returns like dividends or buybacks, this is a trade-off. Google is prioritizing massive investment for future growth over immediate cash generation. This means that while earnings look good, less actual cash is free to distribute to shareholders or pay down debt without further borrowing, at least in the short term. Secondly, other bets remain a continued drag on profitability. While small relative to the overall company, the consistent, albeit slowly growing, losses from these ventures mean they are still in heavy investment phases. They aren't contributing to the bottom line profitability yet. This requires patience from investors, as these are essentially long-term research and development costs. Thirdly, legal settlements and other non-operating volatility introduce an element of unpredictability. The legal settlement charge that impacted operating income this quarter, and the significant swings in other income expense net due to investment gains, highlight potential areas of unpredictability outside their core operating performance. While often one-time, these can impact quarterly results. Finally, the slight dip in Google network revenue, while minor in the grand scheme, is worth monitoring, just to see if it signals any underlying shifts in network advertising trends or increased competition for third-party ad placements.
Understood. Significant investment, suppressing cash flow, the drag from other bets, some non-operating volatility, and that small dip in network revenue. Now, what about the opportunities ahead? Where's the upside potential?
Okay, moving to opportunities. There's immense opportunity in monetizing AI across the board. Beyond just Google Cloud, there's enormous potential to further monetize AI through enhanced search experiences that drive more queries and, critically, potentially more valuable ad inventory, through new, higher-tier subscription offerings across various products, and through AI-powered tools for creators and businesses across their platforms. The fact that AI overviews are driving more queries is a clear path to increasing the total addressable market for search ads. That's a big one. Secondly, cloud expansion remains a significant opportunity. Continued enterprise digital transformation and the accelerating adoption of AI will fuel further sustained growth for Google Cloud Platform and Workspace, especially given their comprehensive and highly differentiated AI offerings and increasing profitability. Thirdly, global growth is a natural next step. Expanding their advanced AI features and subscription offerings to more countries, particularly emerging markets, presents a substantial untapped market for future revenue as AI adoption accelerates worldwide. Lastly, the new verticals represented by the other bets, particularly the scaling of Waymo and the potential of other moonshots once they reach maturity, could unlock entirely new multi-billion-dollar revenue streams for Alphabet far down the line, adding significant long-term upside that isn't yet priced into the stock, perhaps.
Monetizing AI broadly, cloud growth, global expansion, and those long-term moonshots. Got it. Finally, what are the major threats Alphabet faces?
And finally, let's consider the threats. Intense competition in AI is paramount. The frontier of AI is an incredibly competitive battleground, with major tech players like Microsoft, Amazon, and Meta, alongside numerous well-funded agile startups, all heavily investing. While Google states it's leading, continuous innovation, aggressive execution, and rapid adaptation are absolutely paramount to maintain market share and leadership in this rapidly evolving space. Secondly, technological obsolescence is a constant threat in the rapidly evolving tech landscape. The swift pace of technological change in AI means Google must constantly adapt, innovate, and sometimes even disrupt its own products. To avoid being disrupted by newer, agile players or fundamental shifts in AI paradigms that could render existing technologies less relevant, this requires immense R&D spending and foresight. Lastly, broader economic headwinds pose a risk. A significant global economic downturn or recession could directly impact advertising spending, which, despite diversification efforts, remains the largest and most sensitive component of Google's revenue, and could also slow enterprise cloud adoption.
Fierce AI competition, the risk of falling behind technologically, and potential economic downturns affecting ad spend.
Okay. So this brings us back to your question. Is Google the right time and right company to invest in?
This deep dive shows a company with powerfully robust, highly profitable core businesses that are successfully and deeply integrating cutting-edge AI across their entire ecosystem. They are making aggressive, strategic, and frankly colossal investments, particularly in building out their AI infrastructure, to position themselves for future dominance in this transformative field, even if it impacts short-term free cash flow. For an investor, it means weighing robust current performance and a clear, aggressive, future-oriented strategy against the sheer scale of the investment required and the intense competitive dynamics of the AI landscape. Ultimately, investing in Alphabet today, particularly given these Q2 results, is a clear long-term bet on their enduring AI leadership. and their ability to successfully monetize this profound technological shift that is reshaping industries globally.
So what does this all mean for you, our listener, as you navigate the complexities of the modern tech landscape? We've just completed an extensive deep dive into Alphabet's Q2 2025 earnings, revealing a company that isn't just growing at a robust pace, but is fundamentally, strategically, and, I think, irreversibly reshaping itself around artificial intelligence. From search getting more complex and conversational queries through AI overviews and AI mode, to YouTube effectively monetizing the challenging short-form video market and expanding its crucial subscription offerings, to Google Cloud becoming a significantly profitable AI powerhouse, winning billion-dollar deals with leading enterprises. The narrative is crystal clear. AI is no longer just a buzzword for Google. It's the very core of their strategic vision and the driving force behind their impressive financial performance and future growth. The massive, unprecedented $85 billion capital expenditure signals an unwavering commitment to building the foundational infrastructure for this AI-driven future. A future where products like Gemini and VO3 become as ubiquitous, indispensable, and seamlessly integrated into our lives as Google Search is today. They are spending big now, making a deliberate sacrifice in short-term free cash flow because they're betting on winning big in the long run. It seems pretty clear. Here's a provocative thought for you to mull over as you go about your day. Given Google's stated commitment to leading at the frontier of AI and its colossal full-stack investment in infrastructure and research, how might this fundamentally reshape user experience and enterprise operations in ways we are only just beginning to see? What does this mean for the very role of AI in our daily lives, far beyond just search or cloud services? As these advanced capabilities become seamlessly woven into every digital interaction, silently augmenting our capabilities and reshaping our relationship with technology itself. Something to think about. Thank you for joining us on this deep dive. Until next time, keep exploring, keep questioning, and keep getting well informed.